Point taken. Let's take a look at the market. I beg your pardon as we're starting off this segment because the market continues to be very volatile right now. Let's take a look at what is happening at the Nifty. Is there any semblance for recovery, or we continue to see those jagged edges? No, there's actually no recovery. Whatever recovery we did see earlier is getting sold into yet again, so at the lows of the trading session. Good time then to get some sage advice from Jiger Mistry, the co-founder at Buoyant Capital, joining us. Jigar, hi. Good to be speaking with you. Very volatile time right now, and in fact for the last couple of months we have seen it's been fairly sideways for the markets. We do make fresh highs, but only marginally, and then we go into a bit of a consolidation. Is that going to be the nature of the game for the next 6 months?
Hi, Anisha. Nice talking to you as always. Thank you for inviting me to your show. Right, I think you mentioned about the past 2 months, Anisha. I think you go 2 months back, November and December, essentially, the markets rallied something like 14%. Right now, that is an occurrence so rare that it's happened only twice before after the global financial crisis. The first one was when, in 2013, when BJP looked like it will assume office. And secondly, it was post-COVID. So on a base which was fairly high, the markets rallied with the assumption that, I think two events. One, the Federal Market Committee looked like it will pivot sooner. And secondly, BJP with the three-state win looks like they'll form the government at the central stage. Now, with the second part, I think, our understanding was that it was a fairly given sort of outlook, given that they had won 224 seats, even in 2019 with more than 50% vote share. And the federal sort of FOMC, the cuts that were initially expected are now starting to sort of be given into. So in fact, if you look at the debt markets, they are now started pricing in more like, so higher for longer. And in that scenario, equity markets, one needs to sort of trade with a reasonable amount of sort of caution. We have seen a reasonable amount of rally play through, and time is now to be a little more cautious in our opinion.
More cautious is what you're saying, Jigar. Good afternoon. This is Vinny joining in the conversation as well. Jigar, when you're comparing large caps, or let's say the broader markets and the benchmark indices, how would you see that also playing out, right? At some point of time, today at least, we are seeing that underperformance coming in from the broader markets. But what's the story looking like for the broader markets versus when you look at the benchmark?
Right, Vinny. So, I think if you look at since April to January, there are some 367 companies which have more than 500 crores. So we are not really talking penny stocks. And more than 367 companies have more than doubled in share prices, 80% of which are small cap companies. Right. And I think what's happening is that even as FIIs are sort of selling on few months, buying on a few others, there is a continuous inflow of domestic capital, which a lot of mutual funds are seeing. And part of that money, I think, has been coming in from COVID, which has not really seen a massive drawdown. So I think that is one factor. The flows are outweighing the fundamentals in a vast majority. I was talking the previous point earlier. Even the BSE PSU index has rallied only since November. It's up almost 60%. So that's one point. Second point, if you look at the free float sort of market cap and not just sort of classify them as PSU or basis shareholding, then we have seen a tendency where if you actually see a very clear pattern where the lower the free float, higher the stock returns have been and higher the number of companies doubling their share price in the last 9 months. So I think there is this whole phenomenon when you combine that with the fact that a lot of new money is coming in and retail and mutual funds are the ones that own small cap. You've seen a very nifty sort of small cap rally play out. And I think I can argue that there are a lot of pockets where it's now being priced to perfection and then some more. So I think onto your point of broader market. Now, let me give you one more data points. Just in the past 1 month, when Nifty, so in January, Nifty was up 0.0%. So like as flat as you can get. But if you look at BSE 500, the 20th best performing stock was up 35%. The best performing stock in BSE 500 was up 74% in just 1 month. So I think we have seen a broad basing of rally that has played out. And if at all, I think the pendulum has swung to the other side and we need to sort of brace in for impact. The only question is, that, and I think that might be at the minds of everybody else as well, that what is the trigger, right? BJP looks like set to win the third term. The interest rates are benign. FIs are at their lowest holding that they have been in a decade. And they're all positive triggers. But then, historically, we have seen that when things become unsustainable, you only need superfluous reasons for them to come down. So if you remember the rally in 2017, 2018, after that, you had the long-term capital gains budget, which had grandfather gains till Jan 2018. And then there was some mutual fund realignment, which was a flow issue, not as much as a fundamental issue. And by August 19, so from Jan 18 to August 19, there were some 47 companies which had fallen more than 80%, and there were 250 companies which had fallen more than 60%. So I think you can only manage the fund basis flows or fundamentals. I think flows are a lot more difficult to decipher given they can change anytime. SEBI asking mutual funds about their sort of free float ownership could just be the trigger. And or you can manage it through fundamentals, and things are not all hunky dory as far as fundamentals are concerned.
Right. Jigar, just a point that you touched upon right now was a bit in terms of the PSU sides as well, right? So I want to talk a bit more on the PSU because we've seen any of the PSUs, whether you look at the defense, banking side, all these PSUs have seen a very, very sharp run up already. What is your view on the PSU side? Is that now would you be cautious on that front as well? Or, that is still something that, given that we've not seen such a run up in a very long time for PSUs, you would still look at entering something like PSUs, or they are still attractive?
Right. So see, the fact that something, if I can sort of air quote PSU and then that has entered our lexicon, that itself tells you a lot, right? Because who owns a business beyond a point should not really be that material. You could argue that, look, defense looks great and therefore you buy all defense companies, or railways look great and you buy all railway companies. But I think this whole sort of start of PSU as an investable asset class within equities is flummoxing, to say the least. Secondly, if you analyze businesses, now you look at, say, banks, for example. Very interesting, because the credit costs post 2015 are so benign that one is tempted to sort of get ahead and buy the lowest valued PSU bank, assuming that their loss in market share could be as bad as it has been over the past decade. But the NIM cycle and the credit cost cycle is so much in their favor that they become good businesses. Now, in the process, few of them have actually started, okay, the valuation discount between privates and PSUs have narrowed, but some of them have actually gone ahead and now quoting at a reasonably higher valuation than private banks. Now, I can argue on the other side saying that, look, given the fee income, given the quality of the trading book, you'll likely see a ROE for a private bank always be higher than a PSU bank of a comparable size or sort of magnitude. But then, such is the sort of time when PSU as an asset class itself is rallying. So I think we need to take a step back, look at the businesses which are underlying and not just the PSU as a theme which has been playing along. In which case, I can again sort of counter argue saying that, look, the central government spending, which has gone up from, on the capex side, has gone up from, say, 6.5 lakh crore to 11.5 lakh crore, and central governments can spend only through national highways and national railways. So those two segments do look interesting, but they look interesting not just to me, to everybody else as well, which is why the stocks have rallied so much that we could have entered a zone where you might not generate sort of phenomenal returns for the next, I would say, 5 years or so, given what you are already pricing in. So great sort of runway to grow. But when stocks go up like 10x under 2 years, you might have been pricing a lot of it as we speak, and therefore there might not be, on an equity standpoint, a lot of investable surplus to be taken, what the market is not focusing on.
Point taken. So that's the take on PSUs in the banking space specifically. But what about consumption as a basket, Jigar? Clearly, that's one space which is underperformed. And if you just go by the theme that, what has underperformed will play a bit of catch up. There is that mass recovery that people are anticipating. Affluent is already doing very well. Is there a case to increase allocation into consumption and mass consumption at that?
Right. So case to be made, assuming sort of you believe that everything is mean reverting, which over longer terms it is. But see, what we are seeing post-COVID is that there has clearly been a K-shape of recovery, not just with the economy, right? So the people who are doing good have really done very, very well. But towards the lower end of the strata, you're not really seeing that kind of gains percolate through. Now, the government has been wise enough to continue with their schemes, which means that the pain is not really felt at that level. But clearly, in the discretionary, in the sort of staples, you're not seeing the pricing power flow through very, very clearly, Anisa. So, if you look at the quarterly results that have flown by, it's hardly sort of a place where you would want to go ahead and build a reasonably large position. Now, it's not something where, because the sort of outlook is bad, those stocks are available for a song, right? Many of these businesses, your strategic foreign investors are coming in and saying, sort of, yeah, we have a valuation arbitrage. Our businesses don't trade at 50p, which our Indian subs are trading at. So, strategic stakes are being sold into a lot of these white goods slash consumption slash staple names. And until we see a broad based recovery, the rally to the top looks a little bit difficult. Now, there could very well be a place where, if you are believing that, your markets will likely correct a reasonable lot, and that's where you want to hide because they generally offer a low beta play, then that can potentially be an argument. But other than that, it's difficult to make an argument that because they've not performed, let's just go ahead and buy them.
Absolutely, this K-drama seems like is continuing in the consumption story as well. A fan of K-drama, but not this K-shaped recovery that is shaping up. Jigar, thank you so much for joining in with us this afternoon on ET Now, giving us your thoughts on different sectors as well as the markets. That